Welcome back, everyone. My name is Joe Bloodgood. With me today is my partner, Nathan Faith. Topic that we're going to be addressing today is called the hierarchy of retirement accounts, from simple to more complex. And we want to take a look at a specific example of a self-employed individual under the age of 50 making $100,000 of annual income. Nathan, start us off here. Where should we think about a starting spot when it comes to retirement accounts?
Thanks, Joe. Where we start are with the accounts that any one of us as an individual has access to, but that provide a little bit more benefit if we own our own business. And those are individual retirement accounts, whether that be an IRA or a Roth IRA. Now, if you have no other retirement plan through work, an IRA is always tax deductible. It becomes your retirement plan, regardless of your income. And same goes with your Roth IRA. The contribution limit for anyone under the age of 50 is $6,000 a year. So from there, what's the next logical step or progression with retirement accounts? The most common transition that we see businesses make is to move from individual retirement accounts, such as an IRA, to a simple IRA. These accounts are simple to set up, simple to administer, but they do have some limitations. Each employee sets up their own account at their own institution, but the limitations are the contribution amount is set at $13,500 for the employee to contribute, and typically a 3% matching contribution for the employer to contribute. So on $100,000 of income, that combination works out to $16,500 per year, which is roughly 2.5 times the contribution limit that one could make to an IRA. With simple IRAs, the only contribution option one has is to make pre-tax contributions. There is no Roth option, even if an employee wanted it based off of their income. Now, from there, especially with self-employed folks, you see them escalate their retirement plans to one that has potentially more capacity, and it's called a SEP IRA. How these plans work is that there is only one type of contribution. Only you as the employer wearing that particular hat can contribute to the plan. And based off of one's net income, so that's your income after paying all of your expenses, you can contribute 20% of those profits to your own retirement plan. So on $100,000 of income, that'd work out to be a $20,000 annual contribution, which is roughly 3 times the amount that same business owner would otherwise be able to contribute if they instead only had an IRA as a retirement option. But again, SEP IRAs only allow pre-tax contributions. There's no Roth option. SEP IRAs have their place. We oftentimes see them set up because they're simple and easy to open, and they can actually be opened after the calendar year ends, but before one files their tax return. However, in almost every case, the next retirement plan in our hierarchy trumps the SEP IRA in every plan below. So with that, I'll hand off the reins to our 401k expert, my partner, Joe.
Thanks, Nate. Like you said, the 401k does provide significantly more flexibility and diversity when it comes to the amount you can put away, but also the way you can put it away. And so as you can see there on the chart, a 401k is going to allow pre-tax dollars. It could allow Roth dollars. It could even allow post-tax dollars, which could provide additional planning opportunity as you go. But for an individual with $100,000 of income, you can see they've got the ability to contribute $39,500. $19,500 of that would be as an employee. So that's the IRS limit as an employee. And then that additional $20,000 is that same calculation as the SEP IRA, where they're able to put in another additional $20,000 as profit sharing into the plan. A couple of things that we like to think about with the 401k plan are how we put the dollars in. If they're at the point in their career where they need the tax deduction, the pre-tax route works great. If they could use additional Roth savings, it can be some combination of the two. And then beyond that, for folks, and a lot of times we're using the example of $100,000 of income here, but as income increases, the wherewithal to save and the capacity to save increases. And we'll even incorporate a post-tax contribution oftentimes, which will allow a client to contribute a larger amount in a roundabout way to a Roth IRA or Roth 401k via this post-tax method. So once a person has maximized their 401k benefit, yet has additional capacity and desire to save for retirement beyond that, many times we'll introduce what's called a cash balance plan. A cash balance plan is a defined benefit pension plan that allows for contributions on a pre-tax basis over and above that which is allowed for inside of the 401k plan. If this is something that would be of interest, or you'd be interested in having a discussion about the opportunities available to you, please reach out to us at learnmore@boullaygroup.com. Again, you can email us at learnmore@boullaygroup.com.